Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This episode is a special bonus edition. Yesterday, the Federal Reserve voted to reduce interest rates again by a quarter percentage point for the second time in as many months. However, unlike the previous meeting, there was considerable dissent within the leadership of the Federal Reserve. 3 of the Fed governors voted against the interest rate cut. In the announcement, Federal Reserve Chairman Jerome Powell offered very little guidance on the future direction of interest rates. Unlike last month, this time around, you're unlikely to see your banks offer any further interest rate reductions. So why is that? It's because many lenders have already priced in that future rate cut into their offerings. Had the Fed not lowered rates for a second time, you might have seen some lenders increase lending rates slightly. The interest rate that you ultimately pay on a loan depends on what your loan is linked to. Short-term loans tend to be indexed to short-term interest rates, for example, LIBOR. Long-term permanent financing that has a long amortization, say 25 or 30 or 35 years, is typically indexed to the yield on the 10-year Treasury bond. And that yield has actually been falling in recent weeks, so that interest rate is falling. All of this to say now is a great time to be refinancing. A lot of the lenders I've been talking to have been absolutely inundated in the last 2 weeks with new originations and refinance activity. Lenders all over the country are busier than ever. So if you want to get something done, get in the queue because the queue's a long one. As you think about that, have an awesome rest of your day. Take advantage of this great interest rate environment. We'll talk to you again tomorrow.